I think simplistically, the starting process is you're really just trying to look for the anomalies because typically what we've found is when you get a subset of opportunities, throw them up on a sort of a risk-reward basis, you get the classic regression line appearing with about 80% of the stocks probably where they should be, and you really don't want to worry about those. You're really wanting to look what's really undervalued and what's overvalued. And so it's really, as I say, focusing on the anomalies, and then the process kicks in whereby you're trying to work out if they're genuinely an anomaly, because sometimes you do the work and you realise, no, they're really on the regression line. And that's just a combination of understanding how businesses work, understanding how markets behave, human nature, emotion, what drives valuation away from underlying business fundamentals. And then it's just the process, visiting management, visiting companies. Experience obviously helps because you've seen different businesses being valued at different points of time. And often it's as simple as seeing one business, say in the US, selling at 20 times and a business that is very similar in Europe selling at 10 times. And it looks like an obvious anomaly. So that's the start of the process. But there's no one equation to come up with an idea. There's many different ways to come across ideas. So you're using a multiple of filtering techniques, experience, as I said, is very important. And that's how it all starts.
But your investors pay you for a little bit of magic. What magic's had to make the right decision? Or is there human input and error?
Yeah, look, I don't think it's magic. The funny thing is when you look back over 30 years, the same things keep happening again. And typically it's a function that people start to over-exaggerate severe cyclical downturns and start to price them as being impermanent. That's usually where you get your best opportunities. And if you're willing to have a bit of patience, live with a bit of volatility at the bottom, sometimes live with a bit of ridicule because if you want to be a successful investor, basically you have to be doing something very different from everyone else. And often at that key inflection point, you look like a real mug. But bottom line is that's when you find your best opportunities. So as I say, it's a combination of deep understanding of businesses, but typically the real trick or magic is simply arbitraging people's lack of patience and their emotions.
Okay, Steve, forager by name, forager by nature. You've got a big risk appetite when things get very bleak, such as in 2009. How do you get your investment ideas if you're going to be foraging? How do you know where to forage?
Yeah, I think you already heard from Roger and Paul. There's already two quite different approaches and ours is different again. And I think as an investor, step one is to work out what you're good at, what you have the stomach for, and what type of business that you have an edge in looking at. And we buy lots of businesses that lots of people look at me and shake their heads and say, what are you doing? And they tend to be at that beaten up, unloved end of the market. My constitution and my psychology is all about, okay, well, people are hammering this business and nobody wants to own it. That's the time we should be having a look. But we've built up a good record over the last 7 years of sorting out the ones that go broke from the ones that do turn around and become worth something. And that's not everyone's skill set. Some people are much better at finding businesses that can grow for a very long time than I am. So I think if you start with a clean slate, the first step is really to take a step back and try and work out what type of investor you are, what has worked for you over the past decade or decades that you say, okay, that's a space that I feel comfortable, and that's a space where I feel like I can do better than 9 in 10 people that are out there trying to do the same thing as me. And it's a question I constantly ask at work. If we like a stock, why is someone else selling it? And I think to think that you're going to outperform the market, you really need to understand what your edge is, rather than think that there's some golden rule that's going to make you money forever.